Hello, welcome to ACCA F3 Financial Accounting. Today we'll be learning about IAS 38, Intangible Assets. Okay, so let's first clarify that tangible assets are going to be covered under IAS 16 because IAS 16 is about property, plant, and equipment. Now the thing is, intangible itself means it cannot be touched, it cannot be physically felt. So in here, I've written down that IAS 38 is for non-current assets, which has no physical substance, meaning that you cannot actually feel the asset with, because there is no physical substance. And the other criteria would be that it is controlled by the entity. It is a result of past events and results in an inflow of economic benefits. Let me highlight to you that IAS 16 also defines tangible assets with the same three criteria, such as that it must be controlled, it is a result of past events, and results in an inflow of economic benefit. Because for us to recognize an asset, it has to generate some sort of inflow of economic benefit. In other words, the asset has to be used in a way so that it can generate some sort of income or revenue to the business. Only then we can call it an asset. So in here, intangible assets, of course, being an asset, it has to be controlled. It has to result in an inflow as well. But the only difference here is that there is no physical substance. So, when thinking about examples of intangible assets, don't think about land or buildings or machinery. Instead, you should think about something that the company has control over in the long term, but it's something that cannot be felt. So in this case, it would be like goodwill. It could be the research and development that the company conducts. In other cases, it could also be patents or trademarks, because when you own a patent, technically you have the right over something, but that something is not tangible. Okay, it's not the same as if you own an equipment. That you can physically see and you can physically touch. But a patent, let's say a patent over some sort of research you've done, or a trademark, meaning your logo or your slogan, okay? Those are just words, and those are just things that people can see and know about, but it's not something that anyone can feel. Now the thing about intangible assets is that when it is subsequently recognized, after you have recognized it for the first time in the financial statements, that you are going to amortize the asset, okay? When it comes to tangible assets, they are depreciated, but in intangible assets, they are amortized. But the treatment and the way of calculating amortization is pretty much the same. Now we get to the part where we need to consider research and development, because research and development results in something intangible, something that the company can benefit from in the future. Now we're going to consider which of these should be capitalized as an intangible asset and which of these should not be. So let's begin with research. Research is about obtaining new alternatives or obtaining new knowledge about something. So if my company were a pharmaceutical company, this kind of research would be like researching into the type of new drugs that may need to be produced, or researching on the newest diseases that need some sort of medicine to be created to combat against. Now we also need to consider on how research should be treated in the financial statements, because let's think about this. I spend hundreds or thousands of dollars on research, but I'm not quite sure if I can guarantee that I'm going to get some sort of benefit out of it in the future. I may be spending time researching on the new markets that are there, or the existing markets, or what are the possible consumer tastes or preferences in the upcoming future. But of course, research doesn't always guarantee that the information that we obtain can be used in a way so that we can create something out of it, and the thing that we create is going to be successful and going to bring in some revenue into the company. We can't guarantee that. And we cannot directly trace the cost of research that we spent to the products that we have launched in relation to the research conducted. The only way for us to treat research in the books is to expense it off. Now this brings us to our next topic, which is about development, because research and development are two different things. Research was about obtaining new information, but development is a process where we actually already begin constructing something, constructing a product, and therefore we know that it's already something in process, and it's something that is going to materialize, and we know that it's going to generate some sort of income for us in the future. But if you compare to research, IAS 38 says that there is uncertainty over the benefits that we will obtain, and so it should be expensed. But then what about development? What if there is uncertainty too? Now this is where we learn that there are certain criteria that the development costs must meet so that we can capitalize them. If the development costs do not meet all of these criteria, then we cannot capitalize it as an intangible asset. So the first of the criteria is that it must be probable of generating future economic benefits. Probable means a greater than 50% chance that the development costs that we spend on developing a product right now is going to guarantee us some revenue in the future. The second of the criteria is that the company must have the intention to complete the development process and at the end use or sell the product that they have developed. The third one is that the company must have all of the resources necessary for completing the development process. In this case, that means the finance must be there, the human labor has to be there, the technology has to be adequate enough to complete the development. So all of these resources the company must have. If at the end the company runs out of finance in the middle of the development process and they're at a risk of not being able to continue it, then we cannot capitalize the development costs as an intangible asset. Number 4, the company must have the ability to use or sell it. Ability meaning that they have the technical competence, that the people and the staff are well trained and they know well on how to manufacture this product and they know how it's going to be used at the end stage when it's finally done. Furthermore, this also means that when the product is being launched into the market, the public should also know on how to operate the product. So there has to be a sort of ability or a competence on how to use the product. The fifth one is technical feasibility to complete the development process. Technical feasibility is quite similar to the ability of the company. It's similar as in terms of the skills and the competence that the company must have. The last of the criteria is that the expenditure should be able to be measured reliably. So that means, let's say the development costs that I have incurred up to date have been $100,000. That I know for sure is reliable because there are documentation to prove it, like there could be invoices of the materials that I have bought throughout the development process. Now the thing is, what about the development costs that I expect to incur that have not yet happened? Now this is where we will need to estimate it as accurately as possible. So we should gather information on the costs of the raw materials that we are going to use, by how much is going to be needed in the future, and if there are going to be any fluctuations in prices, those must also be considered. So everything that we gather, all of those costs, they all have to be reliable in a way. So the estimation has to be very accurate for us to be able to capitalize the amount. So there you have it. These are your 6 items of criteria that you must meet in order to capitalize your development costs as an intangible asset. Now, after you have capitalized it as an intangible asset, then you shall begin amortizing. However, the thing about amortization is that the amortization only begins when the asset is available to use. Available to use is that when it is finally finished and it is already in the market ready kind of phase, not like the demo phase, only then you can begin amortizing. Alright, now let's start on some questions. So, according to IAS 38, Intangible Assets, which of the following statements concerning the accounting treatment of research and development expenditure are true? Okay, note how it says the word true. First, if certain criteria are met, research expenditure may be recognized as an asset. Now, there is no criteria for research expenditure because research expenditure must be expensed off immediately, no matter what. So this one is false. Research expenditure other than capital expenditure on research facilities should be recognized as an expense as incurred. Now this is exactly what I just said, so this is true. In deciding whether development expenditure qualifies to be recognized as an asset, it is necessary to consider whether there will be adequate finance available to complete the project. Now in here they've said adequate finance available. If we go back to our previous slide, adequate finance falls under resources, which is part of the criteria. So, of course, we need to consider the resources before we can recognize the development expenditure as an asset. So this is going to be true. Development expenditure recognized as an asset must be amortized over a period not exceeding 5 years. Now in here they say must. So in here we're assuming that we have to amortize it over a period not exceeding 5 years. Now, there is no rule about this at all. IAS 38 does not state any principle about any limitation for the amortization, because amortization is usually dependent on the expected useful life of the intangible asset, and the useful life can go beyond 5 years. It can go on for many years. So this one is going to be false. The financial statement should disclose the total amount of research and development expenditure recognized as an expense during the period. Now this is about disclosure notes. Now when referring to disclosure notes, certain things such as the accounting policies, the method of amortization used, the useful life, all of that has to be included. Now another thing that also has to be included will be the total amount of research and development expenditure recognized as an expense during the period. So this is true. So at the end we come down to the answer of D. Now the reason why we need to disclose it is simply just for the completeness and the accuracy of information, so that our stakeholders are aware of what amounts have been recognized as an expense during the period. Now this question is connecting to the next few, so we're going to take a look at the question 9.9 and 9.10 first before we begin attempting this. So in here it says, according to IAS 38 intangible assets, what amount should be charged in the statement of profit or loss and other comprehensive income for research and development costs for the year ended 31st December 2007. So as you can see here, they're asking us what should be charged to the statement of profit or loss. In other words, they're asking what is going to be recognized as an expense. What is going to be expensed off? If they were asking about what is going to be capitalized, they would have mentioned the statement of financial position. So let's go back to that question and look for items which must be expensed. Okay, so let's start from the top. The following balances existed in the accounting records of Copa Co. at 31st December 2007. Development costs capitalized 1st January 2007 were $180,000. Now, please note that it is on 1st January 2007, whereas all of this information is also existing by the end of the year. So in other words, this is like your opening balance. Research and development expenditure for the year, $162. So this was the expenditure that was incurred during the year. So of course, this is going to be an expense. And this is going to be an item that will be in our profit or loss statement. In preparing the company's statement of profit or loss and other comprehensive income and statement of financial position at 31st December 2007, the following further information is relevant. A. The $180,000 total for development costs as at 1st January 2007 relates to 2 projects. Project 836 is a completed project. Balance being amortized over the period expected to benefit from it. Amount to be amortized is $20,000. Okay, so we understand that inside this figure of 180, there is an $82,000 and there is a $98,000. Now the thing is, the $82,000 relates to something that is already done. Okay, and because it is already done, it already has been capitalized, that means amortization will begin. And that's why in here it says the amount to be amortized is $20,000. Now remember that amortization is similar to depreciation, and depreciation is an expense that is charged to the profit or loss statement. And therefore, this is what is going to be included in our SOPL, or our profit or loss. Okay, so that is one item so far. Project 910 is in progress, $98,000. Now the thing is, it's in progress, but it already has been capitalized. So this is still going to our financial position. It's not expense. B, the research and development expenditure for the year is made up of research expenditure of 103 and development costs 59. So in here we can see that from the 162, we have 103,000 and a 59,000. The 103,000 relates to the research expenditure. Now remember, research expenditure is always expensed off. So this is going to go into our profit or loss statement. Okay? Whereas the 59,000 relates to development costs on project 910, which continues to satisfy the requirements in IAS 38 for capitalization. So in other words, this 59,000 relates to project 910 or 910, and it says it continues to satisfy the requirements in IAS 38. So if it continues to satisfy the requirements or the criteria, then we do not need to expense it because it still satisfies as an intangible asset. So far we only have two items that should go into our profit or loss. So that would be the 20,000 of amortization and also the 103,000 for the research expenditure. So in that case, our answer will be A. The next question asks, according to IAS 38 intangible assets, what amount should be disclosed as an intangible asset in the statement of financial position? Now in this case, we need to consider the costs that need to be capitalized or already have been capitalized. So if we go back, that's basically the remaining amount, which would be the 82 minus 20, because now it's amortized, plus 98, plus the 59. 82,000 minus the 20,000 because of amortization, resulting in 62,000. And then we have the 98,000 and 59,000. So this is going to result in 219,000, which is also A. Now let's try 9.11. 9.11 says, Theta Co. purchased a patent on 30 November 2003 for $25,000. Theta Co. expects to use the patent for the next 10 years, after which it will be valueless. According to IAS 38, what is the value of the patent in Theta Co.'s statement of financial position as at 30 November 2005? Okay, let's take a look at the years first. This is 2003, which is right now. 2005 is 2 years later. So basically, we're going to have to calculate the amortization rate per year. So 25,000 is the cost divided by 10 years, which is going to be $2,500 of amortization each year. And so it's going to be amortized for 2 years. So we're going to times it with 2, and our accumulated amortization will be 5,000. So to find like its carrying value, we take the original cost minus the accumulated to get the value on 30 November 2005, which is 20,000. We have come to the end of the chapter. Thank you for watching.